And that's the frustrating part as an investor in silver equities. We'll discuss a few here in a moment that I think are interesting in that when you look at what makes up SIL or GDX, it's producing gold and silver companies. It is not explorers. It's really not developers. It's companies producing ounces right now. So that's very valuable to have that in your portfolio, as I mentioned earlier. But you can't just buy the ETFs and set it and forget it. Like, that's really lazy. A lot of the money is going to be made in the small and microcap stuff that no one's ever heard of before with no analyst coverage. Well, there's a couple of things. I mean, August 1st, we had the non-farm payrolls read in the U.S., and it wasn't just the read that got people like myself more interested in the sector. It was the fact that we revised down the previous 2 months, down 258,000 new jobs in the U.S. If you look at yesterday's stuff, which was December 16th, we had the U.S. government shutdown as well as the December 5th non-farm payrolls moved to December 16th, curiously enough. And those numbers were pretty darn bad. So, like, you're seeing this trend, August, September, October, November, bad job growth in the U.S. And this is one of the things the Fed looks at, right? They have a mandate to keep inflation around 2%. They will look at the labor market. That's one of the two things. CPI is going to be tomorrow, so that'll be interesting to see how that prints. But really, like, I think we're in a Santa Claus rally mode, like you had suggested. I was commenting on Nvidia yesterday because it was right at support, and sure enough, it just popped higher. Like, this is the kind of market that wants to move higher. That's not to say there's not risk. I think next year, tech and AI is really a crowded trade, and I think that we could see a sector rotation out of some of those names and into things like, let's just say, large cap gold stocks, right? I mean, if you look at the earnings for Agnico, AEM, Newmont, NEM, Barrick, B, all this stuff just crushed on earnings the last few quarters. And it's interesting because I worked with financial advisors most of my career, and sometimes I'll show a chart to a financial advisor of something like Agnico, and I'll say, hey, would you buy this chart? Not knowing what the ticker is. And the answer is always yes. And then I show them that it's a gold stock, and the answer is always no. So, it's like we're not there yet in the terms of the psyche of the average financial advisor to move into our sector, but they are noticing gold's ascent. And so they're getting more interested, which I think is really bullish for equities. I've never had more of my brethren over the last 30 years contact me since September than I have in the last 3 months saying, hey, man, I saw you on YouTube, and you sold me some gold at when you were at Sprott at 1,100 an ounce, and now I want to learn more about gold equities. So I think that's really positive.
Equities continue to climb, led by familiar technology and AI giants. Yet this dominance is creating imbalance. At last count, technology represents an unusually large share of major indices, leaving portfolios highly concentrated. Historically, such crowding often precedes rotation rather than collapse. Increasingly, attention is turning toward overlooked sectors with strong fundamentals, particularly large-cap gold producers. These companies have delivered robust earnings and cash flow while remaining underowned. Despite attractive charts and improving balance sheets, gold equities still face psychological resistance, suggesting the broader investment community has not fully embraced the opportunity.
Not really. Like, if you look at GDX, since September of 2022, that was the low. So if you look at the chart,
I more meant the generalist investor stepping in and reaching out to you and trying to get more information on the equity side.
Yes, absolutely. Like, since September, it's exploded. Our business is up 300%, I'd say, inbound. Just people asking for more information and trying to sign up for our services. We have 3 services in particular that we'll go through later, hopefully. And, a lot of investors are searching for information. This is, again, a very, very small sector when you compare it to other sectors. If you look at the S&P as of October 31st, it was about 44% tech as of Halloween. Like, that's crazy. I mean, we're not even 1%. Like, add up all the market caps of every mining stock, it does not add up to 1% of the overall market. You'll have to have me on again in Q1. I don't give out my, year predictions like that far out. I will tell you that we had been calling for silver to hit this 66 to 70 range now for a number of weeks. And I think I mentioned that on our last show, where 50 was the inflation adjusted 66 to 70 in our opinion, more like 68 to 70. And so now that we're at 66, I mean, we're knocking on the door. So it'll be interesting to see what kind of resistance we hit. But clearly today, December 17th, I mean, man, it did not hit any resistance. I mean, it just came out of the gate strong and kept growing. And when you see this kind of move, we saw this in gold, right? For months and months now. Dips are being bought. Silver kind of like, flirted with 54 a couple of times and then broke out, right? If we failed at 54 the third time, we would be in the 40s right now, no question, because, that's just what happens technically. You can't break through a resistance level 3 times. Generally, you're moving lower. But we moved higher, and so we were like right on it on our real-time email service saying at 54, 55, hey, look, we just broke through this level with strength, and we've been telling you guys, once you break through, we don't even know where the next move is because there's never been a price this high ever, right? It's sort of like gauging NVIDIA stock, NVDA. Like, how do you gauge a stock that keeps breaking out? It's fun to see this happening in our sector.
Behind the scenes, interest in gold-related investments is accelerating. Advisors and investors who previously ignored the sector are now asking deeper questions about mining equities. This shift is not driven by speculation, but by performance and scarcity. Compared to massive sectors like technology, the entire mining industry represents a fraction of global market capitalization. That imbalance creates leverage when capital flows shift. Since late 2022, gold equities have quietly built a base, and recent inflows suggest generalist investors are beginning to notice. Historically, this early curiosity phase often precedes broader participation.
Yeah, I mean, especially for the conservative investor, right? Like if you're 55 plus, you have to own some GDX. I mean, this is just a great ETF, and it's going to get a lot more love, I think, next year as it gets more widely known. GDXJ is the juniors, and that has more risk to it. It's small to mid-cap names. And then I do want to mention the silver ETFs as well on the equity side, because many people don't know these. So SIL is the large cap for, comparing to GDX for silver. And then you've got SILJ for the juniors. And both of those have beautiful looking charts. But what's interesting is like a day like today, silver's up about 4%, and those were up about 1%. So, it's a head scratcher, and we've wrote about this in our newsletter recently, why we're not seeing at least the same kind of returns as the metal. This is weird, and it bears watching because people don't, including myself, go into this sector for less than the metal return, right? Like, you don't take that kind of risk in equities to get less than the return of the gold or silver price. So I think it's just going to be a catch-up trade. It'll happen next year. But for right now, it bears watching, right? Because we have a saying in this business, take the stairs up and the elevator down. Like that's how mining can be sometimes, right? Like you make a little bit here and there in equities, and then you lose it all in like 2 days. Like if you don't believe me, look at Liberation Day, Liberation Week in April of 2025. Silver was down on that Thursday and Friday, 12 to 13% in 2 trading sessions. It is a volatile metal, so it is our largest position. I have every reason to tell you guys to keep buying it. But, at 66, it's been an awesome run for us, and we're thankful. And that's the frustrating part as an investor in silver equities. We'll discuss a few here in a moment that I think are interesting in that when you look at what makes up SIL or GDX, it's producing gold and silver companies. It is not explorers. It's really not developers. It's companies producing ounces right now. So that's very valuable to have that in your portfolio, as I mentioned earlier. But you can't just buy the ETFs and set it and forget it. Like that's really lazy. A lot of the money is going to be made in the small and microcap stuff that no one's ever heard of before with no analyst coverage.
Silver has reached levels once considered improbable, breaking decisively through long-standing resistance. Technically, repeated failures near previous highs would have signaled a reversal, but instead, silver surged higher, entering uncharted territory. Such moves are exhilarating but come with risk. Silver is famously volatile, capable of sharp gains and sudden drawdowns. While recent momentum confirms strength, history reminds investors that pullbacks can be swift and severe. This dynamic explains why silver rewards disciplined positioning rather than emotional chasing, especially as prices reach inflation-adjusted highs.
Yeah, absolutely. And a lot of those names are still in GDX and GDXJ, right? They're mostly producers, right? And so, like, where we see some value is in developers. Developers are names that, might be producing in a year or two, and or ramping up production, right? So, like, one would be Denarius, DNRSF in the States, and DMET in Canada. I just spent a lot of time with the company, going through like every metric I could find. I mean, I really take deep dives sometimes when I'm interested. Like as a value manager, some things the chart doesn't tell you the whole story. And what I mean by that is that this is a company that's already producing. Don Durrett, my YouTube partner, and myself, when we look at the universe of gold and silver producers, it's less than 200 names. This is not a long list. And Denarius Metals is one of those names. Now they're producing at a low level, right? They would call that tons per day, TPD. So they're going to ramp up TPD production next year and surprise people, right? And that's going to be producing at a very nice cash flow rate. Now they have some debt they have to address, but it's not onerous. I mean, we've run the numbers a number of times. It's on a net basis, they're going to make quite a bit of money because it's not just their Colombia main mine. They also have a Spanish mine that's going into production in May. So now you're going to have two mines producing gold and silver in the hottest market of all time, and the stock's trading at 43 cents US right now. I mean, it's insane. So that's one that we would look at as a growing prospect. Another one is Norsemont, right? So Norsemont is doing a financing as we speak. That one is NRRSF in the States and NOM in Canada.
For conservative investors, broad ETFs like GDX offer diversified exposure to producing miners, while junior-focused funds add risk and potential reward. Yet a notable disconnect has emerged. Metals prices are rising faster than mining equities. This lag raises questions but may simply reflect delayed recognition. Over time, equity valuations often catch up as margins expand. Still, passive exposure alone may not capture the sector's full potential. Historically, the greatest gains occur in select developers and emerging producers, companies transitioning toward cash flow while still flying under the radar.
They're doing a financing right now. So like when you're doing a financing and it's tax loss season, you're going to get some selling pressure. It's just natural, but these companies need to do raises. Like that's part of junior mining. You can look at the balance sheet and you can kind of discern, hey, these guys have enough cash or they don't, right? But junior miners, every 9 to 12 months, they usually raise $3 to $5 million at least, and they're doing a $10 million raise right now. So it's a little bit of selling pressure, but that's the opportunity as an investor, right? If you look at that chart, Don and I interviewed them at 23 cents US back earlier this year. The stock immediately moved higher, and then it created a new floor, and it never ever dropped below that floor. And then they kept putting out good news. They brought on Paul Matizik, who's a very well-known name in gold, and they've attracted other funds to the stock. So basically what's happening is their float, their public float is getting taken up by large investors that aren't going to sell at cheap prices. And that's why a stock continues to move higher sometimes. So we think here at 61 cents US, I mean, the financing price is around 62, 63 US. You could see it dip into the high 50s. I don't really see like much selling pressure beyond that unless you just get someone crazy here during tax loss season, which is possible. But I think that, another thing I like about that company is that the execs have a lot of skin in the game. They've put a lot of money in at higher prices. So why would they sell here, right? There's no reason for them to sell the project. They're just going to hold it with both hands and ride it higher. And that's what we like to see. Don and I look for companies that have the guts to stick it through this time period to get to a better place for shareholders like us. We hate seeing companies do mergers of equals. We hate seeing companies do a 15%, takeover. It's like, are you kidding me? Like, this is the hottest market of our life. Like, what are you doing? So, there's two names for you that I think are, moving in the right direction.
Within the junior space, careful selection is essential. Developers nearing production can offer asymmetric upside, especially when management holds meaningful equity stakes. These companies often face short-term pressures, such as financing or tax loss selling, that temporarily suppress prices. For patient investors, such moments can create opportunity. Strong assets, credible leadership, and clear production timelines matter more than headlines. In powerful commodity cycles, disciplined teams that resist premature buyouts tend to reward shareholders most. As precious metals markets strengthen, these overlooked names may become the unexpected leaders of the next phase.